All right, so thanks for joining me in today's video. What we're going to do in this episode is we're going to go ahead and take a look at the Cava IPO, and I'm going to share with you basically 4 reasons why I would not be trading this IPO immediately and give you some thoughts and takes on it, as far as trading goes, investing goes, and my personal thoughts and takes. Now, if you have an idea about this before I go into the video, feel free to go ahead and mark your thoughts of what are your thoughts on this IPO. Are you going to be trading this baby immediately or maybe passing on it? So go ahead and write your comments there in the comment section, just on the side. Truly appreciate all you guys that are writing in comments. Great, thank you. And we'll go ahead and take a look at those and maybe add you later on the sheet here or list on video. So anyway, so I'll start out with a couple of my reasonings for not wanting to trade an IPO immediately and right away. So we're going to start with reason number 1 is most IPOs do not perform well as a long-term investment. And if we go ahead and actually take a look at, let's just go in and check out stocks like Bumble. You can see this stock right here. Boom, tanked down pretty heavily. You got Docu, also recent IPO, DocuSign. This one opened up over here in 2018, went a little bit higher and pulling back in the $50 range. Also got Airbnb, ABMB right here. Start off high, let's go to the weekly chart. Start off high around 146, still back at 126. So that's the thing, is that many IPOs, they just don't really perform well. One of my favorite ones to trade, which I recall greatly because I did quite well on this one, was this run in GoPro at the beginning. And then a lot of nice shorting here came out of it. So you can see it's still down in the $4 range. A lot of hype at the beginning, good trading at the beginning, and then a lot of shorting afterwards. So anyways, in essence, many IPOs just don't do well or perform well in the long run. But the ones that do, you're not going to miss out on it. So this gets me to kind of point number 2, or reason number 2, is there's better alternatives to food and restaurant stocks. So if we go ahead and actually take a look at some food and restaurant companies, let's go ahead and check things out. So here we've got CMG, which is not really the best tradable, but you got Yum Brands, McDonald's, Starbucks, Dryden Restaurants. And if we go in and actually look at a much bigger list here, let me go ahead and pull some other ones up. So we got Papa John's, you got Sonic's, you got Denny's, you got Cheesecake. You can see a lot of them. There's a ton out there, restaurants, food industries, but there's only really a handful that maybe are, hey, really good liquidity, tradable, and so on, things that I would enjoy and like Starbucks, McDonald's, CMG, which kind of brings me to point number 3, or reason number 3, there's better liquidity in other stocks and company. And liquidity is quite important because when you look at liquidity and look at just the fact of trading, looking at CMG right here, we've got 48,000 shares traded. 48,000, that's it. It's like a retail stock, but barely anybody's trading it, or barely any shares are trading there. Whereas when you look at Starbucks, you've got already 1.9 million shares traded. And when we look at McDonald's as a food company, you've got 692,000. So a lot less. Didn't realize McDonald's was this low today. But in either case, the point being is that liquidity is very important, not necessarily to getting in. Getting in is quite easy. It's getting out that's usually the problem. So looking at other companies, there's better liquidity elsewhere, meaning you can trade them quite easily. Imagine you had a very rare pair of skates or a very rare Pokemon card. All of a sudden you're trying to trade this thing. Well, there's not going to be a lot of buyers for it. So you're waiting to sell this thing, or a very rare piece of equipment. Same thing. It's a very specific person to trade it. And it's the same thing here, is that if you go in and the stock is not tradable, what you're going to end up doing is, let's look at CMG here. Even though it's getting some popularity and love today, the bid-ask spread is still a couple dollars. If you look at the options market and we look at just on the, let's go to near the at the money range on the option market, you've got a pretty wide bid-ask spread. So you could really get ripped off quite easily, and that's a problem. All right, let's look at reason number 4, and that will be that if it's going to perform well as an IPO or as a company, you don't need to rush. And the ones that do well, they're going to do well, and it's going to take a little bit of time for them to pick up juice and momentum. So let's go ahead and take a look at CMG, for example. If we look at the monthly here and you look at this chart, When it started out, it took nearly a year for it to build up speed and momentum, and then it continued to go higher. So did it matter if you got it in 2006, if you got it in 2007, 2008, 2009? Not really. It was fine either way, and you would have done a good run up. Even if you got it a few years later, let's say you got it kind of, hey, sometime between 2011, 2015, or 16, you still would have done well. Let's look at Tesla, another IPO. If you got it somewhere between 2010 and 2013, you would have done fine. Even if you were late to the party or later between 2014 and 2019, you still would have done quite well. Let's take a look at Amazon here, one of the big daddies. Okay, so this IPO over here, if you got it in 97, 99, 2000s, or even 2001, 2002, still would have done quite well, as you can see. So the point being is that getting into an IPO super early is not really that critical. It's more a lot of, this news stuff and hype that's happening, and it's kind of pushing your energy and momentum to say, hey, get this company, buy this. This is what's happening right now. But the fact is it's not that important. And these are the reasons why I wouldn't rush to jump into these things and be in a hurry. But I always say, look, if you want to see it on your screen and feel good about it, buy yourself one share, feel good about it, and it'll be in your trading account. And then you can always add to it later on. But that way it'll keep your focus, attention, and get the feel good vibes of you having and owning that piece of the company if you're kind of more an emotional person. Anyways, that's all for me today. Truly appreciate you sticking with me and joining me. If you enjoyed this video, feel free to subscribe. I've got some other great courses. If you're into options, check out the other trading channel that I have. And hope you continue to learn, evolve, and expand your mind further. I'll see you next time. Take care.